Hello friends, welcome to our channel. Introduction to Capital Investment Evaluation. Capital investment evaluation is the process of assessing the potential profitability and risks of investing in long-term assets or projects. It involves analyzing factors such as initial investment, expected cash flows, and the cost of capital to determine the viability of an investment. Explanation of various capital investment evaluation methods. One of the most common methods for evaluating capital investments is the net present value (NPV), which calculates the present value of all cash inflows and outflows from a project. Another method is the internal rate of return (IRR), which determines the rate of return that makes the NPV of a project equal to zero. Additionally, the payback period method evaluates how long it takes for the initial investment to be recouped from the project's cash flows. Net present value (NPV) method. The net present value (NPV) method is a technique used in finance to evaluate the profitability of an investment by comparing the present value of expected cash inflows with the present value of expected cash outflows. Internal rate of return (IRR) method. The internal rate of return (IRR) method is a financial metric used to determine the profitability of an investment. It calculates the discount rate at which the net present value of cash flows from the investment equals zero. In simpler terms, IRR helps in evaluating the potential return of an investment and comparing it to other opportunities. Payback period method. The payback period method is a financial analysis tool used to evaluate the time it takes for an investment to recoup its initial cost through net cash inflows. It is a simple and widely used metric for assessing the risk and return of a project or investment. Profitability Index (PI) method. The Profitability Index (PI) method is a financial technique used to evaluate the profitability of an investment by comparing the present value of its future cash flows to the initial investment cost. It is calculated by dividing the present value of future cash flows by the initial investment. Accounting Rate of Return (ARR) method. The Accounting Rate of Return (ARR) method is a financial tool used to evaluate the profitability of an investment by comparing the average accounting profit to the initial investment cost. It is calculated by dividing the average annual accounting profit by the initial investment and expressing the result as a percentage. Comparison of different evaluation methods. The comparison of different evaluation methods in the English language is essential for understanding the effectiveness of various assessment approaches. Whether it's formative assessment, summative assessment, self-assessment, peer assessment, or any other method, each has its own advantages and limitations. Factors to consider when choosing a method. When choosing a method in language learning, it is important to consider your learning style, available resources, and personal goals. Some factors to consider include the level of interaction, feedback, and flexibility offered by the method, as well as its alignment with your preferred learning pace and style. Thank you very much, and we appreciate you spending the time to view this presentation. We greatly value your input. Don't forget to like, share, and subscribe.